I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today is February 22nd.
And this is your interest rate update. Also, we're going to be going into what in the world is going on with rates. Why are they where they are?
This is for informational purposes only. This is not financial advice. But let's get right into where interest rate, what is going on with rates. Over the last couple of weeks, rates have been on a tear. And the big picture is what's driving it, and it's inflation.
Yeah.
Overall, there's fears of inflation. The economy is not slowing down.
And we've said this, usually good news is good news in a normal market. Today, because of inflation, bad news is good news, because the bad news actually means that what the Fed's doing is working. The problem is we're getting still good news. So the Feds are doing certain things, trying to put out the fire, and it's like it still keeps coming.
Yeah. And I don't know if a lot of people understand that when we say good news, bad news, and it took us, when we're trying to articulate this on these podcasts, is that obviously inflation's high. And how does the Fed destroy that? Their job is to basically maintain inflation at low levels, at acceptable levels. They want to be at 2%.
2% is what they've historically done.
Their job is to slow the economy. How do they slow the economy? They need to break it. Their job is to basically or break it or really just...
Yeah.
What do you call it? They don't want to crash the economy, but they have to.
They need to bring it down with a gentle landing.
Yeah. And people say, is it possible that there is a gentle landing, or is it going to be a crash landing, hitting the runway? Well, the point is, we don't know if it's going to be a soft landing or not, but what we do know is that the economy is still showing strength. The job growth. February 3rd was the release of jobs, the unemployment for January. That came in real high. Last week, the inflation number came in, really didn't show any signs of slowing down. And then the cost of production, that the manufacturers and producers in the U.S. and around the world are showing that costs of goods are still increasing.
Mm-hmm. Yeah, and to go back with the whole plane analogy, which is a good one, that can be inflation or that can be the economy. In this case, kind of the same thing. They just need to bring it down slow and steady. But this plane just keeps going at its same altitude. And wait a minute, it's supposed to be coming down. It's not really coming down yet.
Okay, so we could say that, in the last couple of days, let's go first into this. The next Fed meeting is March 22nd. So that is 1 month from now.
We got to wait a whole month.
Yeah, so that's a long time. Between now and then, we're going to have a jobs report in a couple weeks. The first Friday of March, we're going to have inflation numbers come out, but that's all going to be weeks away.
Yeah, and also too, the stock market. Lots of these big companies are reporting their income. I know that we have a lot of the quarterly reports have already been done, but there's still these companies are reporting how they're doing, and that will help things too. If they're doing super well, hey, we just gained 300% more accounts. Again, that's what we kind of don't want to hear.
Yeah, their earnings reports are showing, that's kind of mixed. But right now, the stock market has been rising, but even now, since rates have been increasing, we've seen kind of a pullback in stocks. And let's show them kind of where the Fed rate is, or the probability charts. These are probability charts from the Chicago Mercantile Exchange. It is the CME group, and what I'm going to show you is this. This is on February 22nd, and these are the two numbers I want you to first focus on. The March meeting it's a March 22nd meeting where you see 76%. That was about 90% about 2 weeks ago. That meant that there was a 90% chance that rates would increase. We're currently in this column right here. So this would be a 0.25% hike in this column.
Yeah, that's all people have been talking about. 0.25%. No one's really talked about 0.5%.
So this was I think even higher than 90%, but it was about 90% chance that it would be just a 0.25% hike. And then a 0.5% hike, no one was talking about 90% hike because it was close to a 0% chance. But now there's a 24% chance it's going to be a 0.5% hike.
Yeah, and again, the reason why they have to go a 0.5% versus a 0.25%. 0.25%. And remember, that's doubling. Why would they go twice as high? Again, because this inflation number is just being stubborn.
Next thing we're going to show you is this. So there's no April meeting for the Fed. Fed's going to skip April, and the next meeting is in May, and we can start seeing. I basically drew this line around these numbers right here just to show you that where I drew this box or this, this box here is that there was essentially 0% chance, very low chances that rates would be into these columns. But now there's a really good chance that rates are going to be 0.75% higher than they are today. Even possibly there's about 16 to 30% chance in the summer that we could even get to 1% higher than today.
And remember, we're talking about the Fed funds rate. So we're not talking about mortgage rates. This is the Fed funds rate.
Right. The mortgage rates are building this in already. But again, that's why rates have been increasing over the last several weeks.
Yeah. So again, the mortgage rates increased because all of a sudden they saw boxes that used to have a 0 in it. Now all of a sudden, have something in the teens or 20s. And that's a big chance compared to 0 that we had a couple weeks ago.
And we talk about the 10-year yield a lot because the 10-year Treasury is something that most traders are looking at when it comes to mortgages. The 30-year fixed mortgage, doesn't matter what mortgage it is, the 10-year is what they're all looking at. The 10-year has, in February 3rd, hit really close to a low right there at about 3.3%. And this is the 10-year yield. It is now about 3.95, and it's around a 20% increase in that percentage.
Yeah, that's big.
And whereas interest rates, the 30-year fix since then has risen about 17%. We just did a calculation. Anyway, we'll go right into where those rates are today. So the 30-year fix we are seeing at 6.625, and the 15-year fix we're seeing at 6.125.
The 30-year FHA 6.25, the 30-year VA 6.25.
These interest rates are based off of these loan assumptions for conventional FHA and VA. There's no extra points, no extra fees. These are really typical scenarios. And again, these interest rates, although they are higher, we're mortgage brokers, and these rates are about, I bet you our rates 9 out of 10 times beat other lenders because of the fact that we are mortgage brokers.
Yeah.
We have very low overhead costs, and our structure is just so much better.
So if you do get a 6.625 rate from another lender, likely it's going to have points. Okay. These rates do not come with any points. If you do want a rate option with points, we can do that, which would actually lower these rates. So that is an option. It's not that we don't do points. It's just when we quote rates, we always quote, the at par rate.
Yeah. And something that we're seeing a lot of right now is borrowers doing a 2-1 buy down. They're taking the 30-year fix, for example, and maybe they're locking in at 6.625, but they're getting a reduced interest rate for the first year. Is going to be like 4.625. The second year will be 5.625. So if you have any questions on that, let us know. And any comments, be sure to put them in the comments below. And if you like what we're doing, subscribe and like.
Yep. Give us a call too.
Take care, everybody.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.